This is Daybreak Asia. We're counting down to Asia's major market opens, and Haidi setting up for perhaps a little bit of a lackluster session today. If you take a look at the cues we have from Wall Street overnight, it just seems like investors are really split. Can the rally continue from here?
And it's not just the Fed, right? Of course, we heard from Neil Kashkari speaking to Bloomberg a little bit earlier, saying they're not going to back down from higher for longer until there's confidence that inflation has returned to those desired levels. But also in Australia, going into the open, we had the RBA really signalling that it would be higher for longer in this economy too.
Yeah, that's right. And one of the stories we're tracking this morning on the terminal is just that rents could really be the last domino to fall in this global inflation battle. But this is the open here that we've got for Japan coming online this morning. And at the start of the day, it is that focus as well. And what's happening with the Japanese yen, because you're heading back closer to that 155 mark, as we actually had Governor Ueda meeting the Japanese Prime Minister for the first time in around 7 weeks. That's actually an unusually short period between talks for the two. And so it just tells us perhaps it's a bit of a shifting approach from the BOJ in terms of the yen's direction. And we could perhaps get the BOJ joining the government officials in verbal intervention. Of course, we track a lot of verbal intervention, and we know that they're very closely attuned to the economic impacts. And actually, automaker stocks, for instance, traditionally a key beneficiary of a weaker yen, are now actually starting to see the negatives in turn. Today, though, we've got the Nikkei coming online. Again, just a little bit under pressure so far, but as we said, quite a range-bound day on Wall Street, and so perhaps unlikely to see any major moves, especially ahead of what are very key earnings from the likes of Toyota, for instance, fast retailing later in the week. Let's switch to Korea now, because at the start of the day here, the outlook for Korea is a little bit under pressure. But take a look at that big trading debut that you have at the bottom there. That's HD Hyundai Marine Solution. It's a ship repair company, actually, and it's just started trading this morning in Seoul after raising around $550 million in its IPO. It's the biggest debut that we've seen going back to January 2022, and it really does cement South Korea's position as one of the key markets in Asia for fundraising through equity sales this year. There is only a very small amount of the shares of the company that are being traded today, around 10%. And of course, many funds are going to be restricted from selling due to lockup periods. So that pop, Heidi, a little bit predicted as well, even though, of course, nearly 40%, it's very impressive.
Very impressive indeed. But take a look, Belle, at how we're tracking when it comes to just the first couple of minutes or so of the staggered open here in Sydney. We're looking pretty flat at the moment. Of course, across the region, we're looking to perhaps see some reaction from the tech names when it comes to the Apple announcements overnight. But here in Australia, we're still sort of percolating through the mixed messaging from the RBA. But really the takeaway of rates will stay where they are, and potentially even flagging that possibility of a hike if inflation and these data sets don't come into view for what is manageable for the RBA, is taking some of the wind out of the sails of this equity rally. We're looking at Treasury futures as well as what we're seeing when it comes to Australian bonds, I should mention. Really, supply is the main focus here when it comes to both the American markets, Japan markets as well, and Australian debt markets. A pretty good result of the 3-year note sale in the US, and we saw government debt in the US propelled higher overnight. We're seeing that kind of follow through in Asia as well. The Aussie dollar is holding pretty steady, 65.86. We had a pretty big move in the US dollar to the upside, so a little bit of weakness expected across Asian FX today. Brent crude is looking like it's just holding above that $83 level. Geopolitical developments continuing to weigh here. Traders tracking, I should say, the tensions across the Middle East, the lack of a ceasefire deal over Gaza, and mildly bearish US stockpiles report as well. We did see WTI is tracking pretty close to $78 a barrel there. And of course, as I mentioned, Treasuries, this is a picture for US Treasuries after that 3-year auction. We have also heard a little bit more commentary from the Fed as well. Neil Kashkari from Minneapolis Fed saying that policy tightness is really being questioned as inflation continues to stall. The takeaway from that conversation is really he thinks it's likely the Fed will keep rates where they are for an extended period of time, Belle.
Yeah, Heidi, let's get more on the market open now. As we said, Japan just coming online and sort of set for a bit of lackluster trading. But our next guest says that valuations there still look attractive versus other developed markets. Ken Wong is Asian equity portfolio specialist at Eastspring Investments. And Ken, Let's kick off with Japan here this morning, because I think it's a bit of a broader question really facing investors right now. The rally that we've seen so far, are there enough catalysts for it to extend? But Japan, having already seen such a big run-up, are we looking stretched at this point in time, or do you think there's further room here for upside?
I think you have to look at specific segments. The fact is that when you look at large caps, they have run up quite a bit. But then in particular, when you look at mid and small caps for the Japanese markets, they're still very attractive. You've got over 40% of the stocks in the mid and small cap space, which are still trading 1 times and below book. And the fact is that especially, yes, the past couple of years, we've seen a very solid rally, but we think that this year it comes to be much more important for stock selections. So you got to be a bit more careful when it comes to, not trying to chase specifically, maybe the flavor of the month for the previous winners, and really just focus on those momentum stocks, because the valuations on those stocks have gone up quite a bit. But again, there is still quite a number of sectors that we see that are still very attractive in Japan.
We were just speaking before with our Japanese equity reporter Hideyuki Sano about the impact of the weaker yen, and it has traditionally helped the exporters, in particular the heavyweights on the index. But what impact are you seeing, and do you think it's actually starting to have a negative bearing?
There is some. I mean, depending, like you said, some of the exporters definitely will have a bit of an impact. But the thing is that when we look at Japanese markets as a whole, our cap rates assumptions is actually at 2.5%. So we actually already have a fairly big buffer and margin of safety already, given where interest rate levels are at right now and where we actually see cap rates. So the fact is that when we look at specifically, a lot of the companies, we look at a lot of the, I would say, maybe the unloved companies, maybe from maybe contrarian point of view, from a more value style investing, we still see a lot of opportunities there. Because especially I would say that over the past 6 months, there's been a lot of push towards, as I mentioned earlier, around momentum, around growth stocks, because everyone assumes that, with strong growth and everything, sort of reviving, capex reviving, that growth stocks are going to do very well, which they have. But at the same time, because of that, that's where you might want to have a bit of a style rotation to really start looking at some of the value stocks, which are definitely becoming much more attractive again.
Speaking of rotation into more attractive, perhaps, geographies, I wanted to ask you about China, because take a look at this chart when it comes to where we're trading in Shanghai. I'll get to Hong Kong in just a minute, but even Shanghai at the moment seeing kind of fresh technical signals that perhaps this is a true revival, right? The Shanghai comp 16% gain from February, the 50-day moving average now above the 200-day moving average. So this is the first bullish cross since early last year. Do you see this as a fundamental re-rating, or is the question, is that still in question depending on further policy execution and signs of a recovery?
Yeah, that's a great question, because the fact is that when you look at where we are today as compared to a year ago, the fact is that we're still roughly around 10 to 15% below the levels that we were just a year ago. So the fact is that despite we had a fairly solid first quarter GDP number, and it did have a bit of a surprise, I would say, to some of the market participants, the fact is that when we look at overall valuations from, let's say, the CSI 300 perspective, it's still below its 10-year historical averages. So we think from a valuation perspective, it's definitely a lot more enticing. And the fact is that while we have had a strong rally, especially here in Hong Kong, with a lot of the H shares, red chips, and some of the P chips as well, the fact is that still a lot of the A share stocks haven't seen that strong rally that we have seen here in Hong Kong. So we believe actually on the onshore platform that there is actually going to be quite a bit of opportunities right now for investors, especially given where valuations are and given such a really, I would say, a low starting point compared to the levels where we were from last year.
Is it going to get harder for Hong Kong now? It's been, what, a 20% bull run over the past 3 months. So there seems to be sort of a setup for multiple headwinds from here.
Yeah, I think that first wave that we saw was, quite a bit of short covering. But then now we are definitely seeing a bit more interest from institutional investors wanting to hear more about what's happening in this part of the world again, wanting to see specifically, whether or not from an economic perspective and from policy perspective that things can be very accommodative in order to support the markets in the second half of the year. And also at the same time, because of where valuations are and given the opportunity set, there is actually a bit more certainty, I would say, in terms of investing in this part of the region. And that's why you're getting a bit more of, sort of an interest in terms of investor sentiment here in Hong Kong. And, eventually we feel as well within the China A-share market as well.
And the international fund investors that you're speaking to, which sectors or areas are they most excited about, do you think, at this point in time?
At the moment, they want to hear just the whole macro story. They want to know specifically whether or not the growth is sustainable. We talk about, and we hear about 5% GDP growth for this year, whether or not that's going to be achievable, and even so, how is that going to be achievable? They want to know specifically from that standpoint. Whether or not we see further capex cycles, improving and increasing in China, that's also going to be important. And also at the same time, just from an overall economic perspective, how things will evolve during the second half of the year. So I think right now, it's much more of a bit of a feel from the international investor base. But again, that's a start. And I think then as time progresses, we might see a bit more interest in terms of specific sector rotations and stock selections.
And how much is because there's always an opportunity cost here, but how much is India at risk from those possible inflows into China?
Well, we're election month, right? So the fact is that right now, I think a lot of investors, and especially over the past, I would say not over the past 12, 18, 24 months, there's just been a really strong focus on India. So there could be a slight pullback potentially, once after the elections are over. But with that said, from a medium to longer term perspective, there's a lot to like in India. Mm-hmm. And the fact is that, yes, while valuations are a little bit high at the moment, but you look at it from the longer term perspective in terms of economic growth and more importantly, earnings growth and the increase in capex cycles for a lot of Indian corporates as well, there is a lot of opportunity to invest in India for the medium to longer term.
All right, that was Ken Wong there, Asian Equity Portfolio Specialist at Eastspring Investments. Thanks so much for coming in this morning. And we are just bang on 10 minutes into the session so far for trading in Tokyo and Seoul, also Sydney. But there's really one stock that's standing out to us this morning, and that is this ship repair company, HD Hyundai Marine. It's just making its trading debut in Seoul this morning, and it's jumping there, surging more than 40%. After it raised around $550 million in its IPO that was priced at the top of the range. Also strong demand coming for it. The stock, only about 10%, or the company, only about 10% of its shares are going to be traded on the first day of trading. So these gains were sort of predicted by some of the analysts that we spoke to, including DS Investment and Securities. And they're actually saying that many funds as well are going to be restricted by selling or from selling by lockup periods. But this is certainly a company or a debut that's cementing South Korea as one of the key fundraising venues in Asia over the course of 2024. We'll have more ahead. This is Bloomberg. TikTok's owner has now launched a formal legal challenge to the law forcing it to divest or face a ban. That set up what could be a prolonged court battle pitting free speech rights against national security interests. For more, let's bring in our Chief North Asia correspondent, Stephen Engel. And Steve, this was really telegraphed very clearly by the company that it would make this sort of move. But what are the sort of details then of the challenge?
Well, the interesting thing, I'll take a step back and say what that ban is going to entail. Essentially, they had until January 17th of next year to essentially, for ByteDance, that isn't TikTok, to divest its Chinese ownership, potentially sell it to another company in the United States. They've already said that they've spent about $2 billion to essentially make sure that, it will isolate its U.S. customers from any concerns on national security grounds, and also kind of be agreed to oversight by the software company Oracle, okay? Well, still, that didn't necessarily matter because Biden signed this bipartisan law last month. And so they have until, as I said, January 17th. But now, in this filing of a lawsuit by TikTok saying, listen, we're not necessarily going to comply with this. They might have to get in closer and seek an injunction closer to that date. But right now, they are still operating in the United States under the same framework that they have all along. Except now, what is going to happen with potential buyers? We heard Steve Mnuchin, the former Treasury Secretary of the United States, looking at possibly if they can't join them or buy them, if they're not going to be selling, then maybe that they will look at the algorithms and come up with a different type of service similar to that. We also had former Google head Eric Schmidt saying he's against regulation, he's more for regulation against a ban. So there's so many moving parts. But now that this is potentially going to be a long, drawn-out court battle that could end up in the Supreme Court, it just prolongs this whole saga. And again, TikTok fighting for its survival in the United States market, where they say, they supply this platform to many small, medium-sized companies and also individuals who make a living off of TikTok.
It's not the only saga, right, in this space. We've heard more action taken against Huawei by the United States.
Yeah, that's right. I mean, they're, according to sources, expanding those export restrictions against Huawei. Essentially, according to these sources, the United States government has revoked licenses allowing Huawei to buy semiconductors from Qualcomm and Intel, basically affecting U.S. sales of chips used in Huawei phones and laptops. The U.S. Commerce Department confirmed the withdrawal of certain licenses for exports to Huawei, but declined to offer specifics. But we've already heard from the likes of House Foreign Affairs Commission Chairman Michael McCaul, the Republican from Texas, who says this will block any chips sold to Huawei, saying that Intel and Qualcomm are two companies they're worried about being a little too close to China. Well, for Qualcomm's sake, they say their business with Huawei is already pretty limited and will surely shrink over down to nothing over time. It has been allowed to sell older 4G network chips to Huawei, but again, not 5G and advanced chips. Huawei doesn't rank in Qualcomm's list of top 10 customers. Same for Intel, this according to Bloomberg supply chain analysis. But, you know, U.S. officials also said to be considering sanctions against 6 Chinese firms they suspect could be supplying chips to Huawei. U.S. also, of course, as we've been reporting, Haidi and Annabelle, that they've been pressing their allies like Japan, like South Korea, like the Netherlands, Germany, and the like, to also amp up their pressure and not sell to companies like Huawei.
Chief North Asia correspondent Stephen Angle there in Hong Kong. Well, the former US Treasury Secretary Stephen Mnuchin says he's still interested in buying TikTok's US operations from ByteDance. He spoke to us at the Mnuchin Institute Global Conference in Beverly Hills.
Still very interested in buying it, and to the extent they want to sell it or spin it off, we very much want to pursue that. I support that Congress passed the bill and it's now been signed into law. I will say this has had just incredible, overwhelming support with Republicans and Democrats. This may be the only thing that everybody agrees on. The fact that it's on 160 million phones, I do think it's a security issue.
Does the deal still work if the algorithm doesn't come with TikTok?
Well, the Chinese government has been very clear that they won't give an export license on the algorithm, and I understand that. We have sensitive technology that we don't want to transfer to them, and they don't want to transfer this to the U.S. I've actually spoken to a lot of tech companies on working about rebuilding this. I do believe the algorithms could be rebuilt. So my plan, if we were to purchase it, would be to rebuild the technology under U.S. leadership, make sure that it's all disconnected from ByteDance going forward, and that it is very robust and secure.
That was the former U.S. Treasury Secretary Stephen Mnuchin speaking to Wall Street Week anchor David Weston there, and sticking with that theme of China and possible tensions, but Chinese President Xi Jinping has arrived in Serbia on the second leg of his European tour. He's looking to bolster ties with a country that's embracing Chinese trade and investment. For more, let's bring in our Asia government and economy correspondent, Rebecca Chung-Wilkins. And Rebecca, looking to bolster ties. I mean, I believe that both sides are expected to sign as many as 30 agreements here. Yes, it's really bolstering it.
Quite a few in the offing. I mean, this is just a fascinating portion of the trip to me, this visit to Serbia and then to Hungary. These are two countries which are not just economically open to China, but geopolitically much closer to China too. Sort of two rare offerings in Europe there. So both Serbia and Hungary have a much closer relationship to Russia. They are trying to tread this relationship between Russia and the West. That has been a sticking point. And also they have this sort of deeper mistrust of US-led world order, NATO. They are sort of buyers of that idea that Russia and China promote of the multipolar world order. So really for Xi, this is not just about the sort of economic benefits that showcase the benefits to the rest of Europe of engaging with China. These are both two BRI nations, for example. But it's really also about just reaffirming those and signaling that reaffirmation of very close ties to Putin. We are, of course, expecting Putin to visit China, in the days after Xi Jinping returns.
Rebecca, we spoke yesterday about how, there's been obviously a lot of these sort of goodwill, carefully selected visits and meetings, and maybe some of the tougher conversations have been around the periphery. The meeting with the European Commission, that was pretty full and frank about what Europe wants from China and what could potentially happen if concessions are not made.
Yes, this is the sort of major sticking point, and the whole discussion here is around this issue of overcapacity. And it's a major obstacle for Beijing because any sort of more trade friction, tariffs and so on could pose quite a major obstacle to China's so-called new three drivers of growth, looking at batteries, solar and EVs. And the issue there is that we have seen the European Union increasingly move closer to the US position here, moving lockstep when it comes to introducing this litany of probes. But it does seem like, despite those frank conversations, in some ways that may be a marker of the more sort of forthright and deeper discussions that can happen. Because if you compare, for example, the discussions between China and the US versus China and the EU, you do see this more forthright, this more concrete, this more deep sort of discussion and debate. China, of course, as expected, very firmly saying that there is no problem with overcapacity when it comes to those key industrial sectors. But, we will have perhaps see more of this effort to move, for example, some of those Chinese EV makers and so on into onshore Europe, i.e. opening up factories or using currently unused factories to set up operations, create local jobs, help local economies, and thus boost sort of the local economy for certain member nations. We've seen that happen selectively in Spain, in Hungary too, of course. So that may be one way that China is able to sort of reaffirm the benefits, the economic benefits of keeping those ties open.
Our Asia Government Economy correspondent Rebecca Chong-Wilkins there. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers can find that at Debut Go on their terminals. It's also on the mobile in the Bloomberg Anywhere app. You can customize those settings too, so you just get the news on the industries and assets that you care about. This is Bloomberg.
I think the most likely scenario is where we are right now, which is just we stay put for an extended period of time until we get clarity on is disinflation in fact continuing or has it in fact stalled out. I don't think we know the answer to that, so I would say the most likely scenario is we sit here for an extended period of time.
That was the Minneapolis Fed President Neel Kashkari speaking at the Mnuchin Institute Global Conference in Beverly Hills, and those comments are one of the reasons it's being attributed this morning to those strengths coming through into the greenback. More overnight, of course, we actually saw the biggest jump in a week, but Treasury yields as well paring their losses after we heard from Kashkari there questioning whether monetary policy is restrictive enough. Certainly didn't close the door to the risk of another rate hike. So that's the state of play for Asian FX so far. Again, a little bit subdued, but keeping a very close watch on the Japanese yen, because we as well had a meeting between the BOJ Governor Ueda with the Japanese Prime Minister Kishida as well, talking about these recent FX moves and perhaps a signal to us that the BOJ will follow suit with Japanese government officials in starting to jawbone and talking up perhaps the risk that there does need to be some sort of possible intervention. Of course, those two episodes not confirmed as yet. BOJ's Ueda as well saying that monetary policy not supposed to be a tool to control FX either. But that is the state of play, as we said. We've got equity markets just half an hour into the trading session as well this morning, and the outlook today is fairly subdued. We're actually seeing the broader gauge declining down 0.4% at this point in time. The topics there you can see one of the bigger drags down 0.8%, but we'll have more ahead on Daybreak Australia, or Asia rather. This is Bloomberg.
The US says Israel and Hamas should be able to resolve their differences over a proposed ceasefire in Gaza. That contradicts top Israeli officials who say the two sides remain far apart. Truce talks have been stalled as Israeli forces edge closer to the city of Rafah. For more on the crisis, our Bloomberg editor Michael Heath joins us now. So talk us through, I guess, the timeline in terms of where operations are in Rafah. We're seeing a lot of footage of, things developing and getting closer, and whether there's any opportunity now for the sides to come together for this ceasefire or truce.
Yeah, so Israel hasn't gone into Rafah, the city itself. What it's done is it's taken control of the border with Egypt. Its argument being that that's where cash and weapons and that sort of thing are coming through to militants. It's sort of a bargaining chip in a way. It's a way of Prime Minister Netanyahu keeping his right wing on side. Yes, we're moving, we're going ahead. It's also a way of putting pressure on Hamas because it takes away another one of their chips as well. As to the talks, Haaretz, the newspaper in Israel, is reporting that Israel actually sent lower level officials there. So it's going through the motions of doing it, but despite the US saying there's not a big difference, the reports are the difference is, I think as we mentioned yesterday, that Hamas is saying it doesn't have enough live hostages to fit the criteria, so there'll be some dead bodies involved, which Israel rejected. And it also has again sort of said that, that the war sort of needs to stop. Now, the US says that it's still not far off, and potentially that's right. They are right, it is negotiations, but they're both sort of red lines. And this is the difficulty of coming through it is one side insists the war ends, one side insists the war can't end. Can you find a route through that? It's very, very difficult. But again, the US pressure is strong. The Washington Post is reporting that that the US has delayed sending weapons to Israel. I suspect that's part of the pressure it's putting on from its side onto Israel. And no doubt Egypt and Qatar are putting the pressure on Hamas as well. All sides outside of the warring ones really want an agreement here and the hostages to be released.
But as you said, Michael, Hamas can't actually meet some of the terms of the deal. If you can't even meet the live body count, for instance. So what's the outlook then for talks or negotiations?
Well, this is the thing, Annabelle. Do you trust what Hamas says? I mean, at the end of the one ceasefire we have had, they did try to switch in dead bodies for live hostages at that stage too, which Israel rejected. So no one's quite sure how many people are actually alive among these 100-odd who are still unaccounted for. One school of thought is that Hamas is doing this because it wants to keep more hostages around itself to, as insurance. Another school of thought says, well, after 7 months of war and these people being dragged from pillar to post, trying to escape Israeli forces, etc., probably a lot have died. So it's really uncertain whether Hamas can actually meet that or not. The Israeli public, according to the latest poll, really overwhelmingly want hostages returned. They want that more than they want the Rafah crossing done. The city of Rafah to be taken and the last bastion of Hamas to fall. But then, you have this right-wing government, very, very right-wing, with extremist settlers in there who insist that Rafah must be taken, the war must be taken to its conclusion, and that's the only way to release the hostages. So we're really, really up in the air. I mean, it's just hard to know with Hamas. Obviously, its leader, Sinwar, is in a tunnel somewhere around Rafah, no doubt. So communication in and out is quite difficult as well. So we're really sort of in this holding pattern. I mean, Israel does seem to want its hostages out. It is trying to pressure Hamas into coming up with the deal. And Hamas also has a reason to sort of agree to it if it feels like this could be the end in terms of Israel going ahead with an operation.
In the meantime, some of the top universities in the US continue to have this difficult balancing act of dealing with these encampments. Right now, a lot of the focus is on financial disclosures and the divestments. Yeah,
there's been some reporting out of that as well, that part of the deal to get some of these pro-Palestinian protesters to leave was that universities would agree to financial disclosures or to even discuss the idea of divestment with Israel. The irony being that, of course, some of the biggest donors to these universities are Israeli business or Jewish business figures in the US who are really, really unhappy about this. So, look, it's a difficult situation. This also plays into President Biden's problem. He really doesn't need this war to keep going and fueling fueling protest groups, because at the end of the day, these people, to some extent, are part of his coalition that could propel him to victory. He doesn't need disunity there. He wants everybody on the same side. So getting a truce, bringing this to an end, diffusing that sort of protest movement as well would be very much in his interests.
Bloomberg editor Michael Heath here. Well, surging rents across many developed economies are proving to be a stubborn hurdle for central banks in their global inflation battle. In the US, UK and indeed here in Australia, rapidly rising housing costs are keeping price pressures simmering. For more, let's bring our economics reporter, Swati Pandey. So, Swati, we know the situation in even places like Sydney, right? We've seen Australian rents hit record highs, just extraordinary increases that are being talked about. This is proving to be a real difficulty when it comes to the fight against inflation.
Yes, that's right, Heidi. Like most of last year, we were seeing a slowing down in inflationary pressures globally. And even though central banks did not say that they have won this battle against inflation, markets had actually gone ahead and started pricing rate cuts. And now what we are seeing is a re-acceleration in housing costs, partly driven by immigration, partly driven by housing shortages in countries like UK and Australia. And that is again reigniting inflationary pressures, and that means the disinflation trend that we were seeing over last year has stalled now, and that is a big worry for both central bankers and financial markets and investors.
Is that sort of phenomenon typical, rents being the slowest to come off during a tightening cycle?
Yes, the economists I've been speaking to for this story say that rents tend to be a lagging indicator. But this time is a bit different because it has come after the pandemic, when people had a lot of savings to spend on rents, move to bigger houses, move out of shared accommodation, move closer to city centers. And that actually drove rents higher in some pockets. And then we also had immigration in some of these countries, Canada, Australia, UK, which also drove demand. So this time it just feels like it's not only taking longer to come off, we are seeing a re-acceleration. So in Australia, we had median rents hit a record high in April. In UK, rents are rising at the fastest pace on record. So it's not like they are taking time to slow down. They are still rising, and they are rising at a record pace. So that is the worry.
The problem is mostly supply driven. So in that sense, monetary policy is a pretty blunt tool and unlikely to be able to help. Are there sort of policy measures in the pipeline that could ease supply?
Yes, in fact, at the Reserve Bank of Australia's press conference yesterday, Michelle Bullock was asked this question, and she said the worry is with rents remaining high, even though interest rates cannot do anything about it directly. What it does is it keeps inflation high and then fuels into inflationary pressures, and then people demand higher wages, and then it kind of becomes a self-fulfilling cycle. And in terms of what other policy measures are, the two big one is to probably boost housing, but that is going to take time. It's not something that can happen quickly. The second is to slow down the pace of immigration to a level which is more accommodative for every economy, which some countries have already begun doing, including Australia. So I mean, it looks like we will see a slowdown in the pace of housing costs, but it's not going to happen very quickly.
That was our economics reporter, Swati Pandey, there in Sydney. And a quick check on how markets are faring so far. We're 40 minutes into trade for Japan, Korea and Australia so far, and we were talking about really that it would be quite lackluster trading. Actually, when you take a look at trading volumes, we're a little bit off the typical day where we would be, say, over the last 20 days or so. Japan, you can see they're really the big laggards so far in the session. It's actually pretty busy earnings day ahead. We've got the likes of Toyota, Mitsubishi Heavy as well reporting their numbers. Crafton and Seoul also on the docket. But let's take a look at some of the movers in particular, because Nintendo is one of the stocks we're really focusing in on, and it's off more than 4% at this point. We actually had it reporting an earnings miss. Their forecast falling quite far short of estimates. What was sort of more of an optimistic part of the earnings, though, was that the company said it would announce a successor to its 7-year-old Switch game console. So we will get an announcement on that in the coming year. We do expect, though, the company expects operating income to fall 24% in this current period. What else we're tracking is a very big surge in Seoul this morning. If you take a look at how HD Marine or Hyundai Marine Solution is trading so far, up more than 40%. Biggest debut we've seen for Seoul going back to January 2022. A strong indication for the sort of investor enthusiasm we're seeing for Korea, that's also pushing through with corporate governance reforms, but it has really been the key, or one of the key fundraising hubs for equity sales in Asia so far this year. Be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team, broadcasting live from our studio in Hong Kong. You can listen via the app Radio Plus or BloombergRadio.com. Plenty more ahead. Stay with us.
Some breaking news when it comes to the Australian money manager Perpetual and KKR. Perpetual is to sell 100% of its wealth management and corporate trust businesses to KKR for total cash consideration of 2.175 billion Australian dollars. We're learning that the board has unanimously recommended shareholders vote in favour of the deal. Under this deal, the managing director and CEO Rob Adams will retire upon the completion of that deal, and that is expected to occur in February 2025. Some of the more details: Perpetual holders expected to get that cash proceeds as well. Units will be sold for that $2.175 billion total. We have heard that then what happens to Perpetual is that it continues trading to become a standalone multi-boutique asset management firm. This will then become just a pure play funds management business under a new name, according to reporting that we had before this deal was announced. It is expected that that proceed will be used to pay debt and tax. Some capital will likely to be left over to return to shareholders, according to some of that previous reporting. We had heard, of course, that Perpetual had started to review to unlock value for shareholders at the end of last year. There had been early interest in the company from EQT AB, amongst others. They had earlier rejected a $3.5 billion Aussie dollar takeover offer from Washington H. Soul Patterson and Co. in December. The Australian investment house was an option at that point, but we're now hearing that these two units, wealth management being one of them and corporate trust business in the other, will be sold to KKR for that 2.175 billion Aussie dollar total. So we'll bring you more details on that deal as they get to us. But let's take a look at how we're trading when it comes to currencies. We did see that big jump when it comes to the US dollar, and that is having a little bit of sort of impact on the yen. At 154.84 is where we're at. We heard again from policymakers in Japan saying they're ready to take all possible measures on FX. The finance minister most recently this morning, Shunichi Suzuki, saying that the government continues to closely monitor these levels in the FS market, standing ready to take all possible measures as needed. So saying that it is important for rates to remain stable, to reflect fundamentals, and excessive fluctuations are undesirable. So much of the same commentary and jawboning that we've heard from officials previously, but we have seen relatively steady levels in the yen over the past few sessions. And of course, typically, we have seen that weaker yen really benefit Japanese automakers in particular. Let's take a look at how those car makers are faring as earnings season begins. Toyota, Nissan, Honda and Mazda are all set to report this week. And very interestingly, we were speaking earlier to one of our reporters who was talking about that fading correlation between currency benefits and how we see performance in stock prices of those automakers. They're all trading down at the moment. Toyota is widely seen to lead US sales in particular, and the biggest gains in shares in 2024. Let's bring in for some analysis Christopher Richter, who's a senior research analyst at CLSA. Christopher, great to have you with us. So what is going to be kind of the highlight for you in terms of the outperformer out of the Japanese automakers this earnings season?
The two that I'm really going to be focusing in are Toyota Motor, which you just talked about. We're very curious to see how they guide because they're most likely to post record earnings this year. Not so much on the currency, as you mentioned earlier, but more on the fact that the last fiscal year was the best sales for global automotive in a decade, as the market last fiscal year recovered from COVID and the chip shortage. And this is going to benefit Japanese makers across the board, particularly Toyota. We're curious to see how they guide with that, what they assume about the currency, and also maybe for this fiscal year, what impact some of the compliance problems they've had at subsidiaries like Daihatsu and Toyota Industries have had on it in the final quarter of the year. The other one we're interested to watch is Subaru. Subaru's been having some new product launches, had seen some strong growth in profits earlier in the fiscal year, and we know they have more product coming in fiscal March 25.
It's interesting because EVs and hybrids play such a big part going forward in guidance, right? Toyota's been criticised in the past for being too slow on that front. Are they best placed to benefit, particularly in light of geopolitical tensions and the competition from China, but also that access to the US market?
Well, it's funny, for all the criticism they've had in past years about soft pedaling on EVs, they look pretty prescient right now, given the interest in hybrids that we have been seeing, and it's very positive for their bottom line. Granted, this is, I think, a respite that might last for a couple of years. Eventually, they're going to have to turn more to EVs, and we do know they have a lot of R&D activity going on right now to have improved EVs in the market starting around 2026. But for now, it's game on with the hybrids.
The R&D that they're putting into EVs in particular, do you think that that's going to allow them to remain competitive with the Chinese automakers that are really just capturing so much market share?
Well, that's the goal. And the question is what's the long-term future, not just for Toyota in China, but every single Western, legacy automaker in China, because they've all lost quite a bit of market share over the last 4 years, particularly in the last year as, EVs have really taken off in China, and China is by far the leading EV market in the world. Or does everybody retreat and say, okay, China is sort of a Galapagos, and they worry about the rest of the world. But I think Toyota wants to get in the game. I think they need to be the equal of both BYD and Tesla in EVs, and I know they're working towards that. Question is, can they do it?
Well, yeah, because we've seen Toyota, for instance, pairing up with China's Tencent, and Nissan's going to team up with Baidu. What do you make of those partnerships?
Well, the big thing about the big change in Chinese EVs, particularly since the pandemic, is they're viewed less as cars; they're viewed more as devices, and being associated with these tech companies is they need to import some of that technology and know-how into their cars, especially since technology doesn't flow freely over borders these days. You really need to have, one solution for China and one solution for everywhere else.
That was Christopher Richter there, Senior Research Analyst at CLSA. Thanks very much for your insights ahead of those very closely tracked Japanese auto earnings. We'll have more ahead on Daybreak Asia. This is Bloomberg. Well, it's a pretty lackluster trading session so far for Asian equities broadly, but one is really standing out to us and giving us something really to talk about this morning. That's HD Hyundai Marine Solution. It's a ship repair company. It's just started trading in Seoul this morning. And let's get more on that now. Bringing our equity capital markets reporter, Felipe Pacheco. And Felipe, it's an incredible result so far. 40% surge on the first day, but I think it was a little bit expected as well, right?
That's right, Belle. I think it's great to be here to have actually something good to talk about. It's been so tough, the market here in Hong Kong. It's Definitely a refresher. You're right. It was expected to see a very good performance at the first day of trade today in Seoul. This is a company that's part of the Hyundai group. It's a very specific business. They actually work in repairing ships for clients all over the road. And what we heard during the IPO is that there was very good demand for the shares, 200 times above. There was demand that was 200 times above what was being offered. Stock was priced at the top of the range. The size of this IPO is around $550 million US. If we were talking about this size of a deal of this size maybe 3 years ago, it wouldn't be outstanding, Bell. But this year, this is the second largest deal in Asia Pacific. So definitely a very big deal. It's the largest in Seoul since 2022. And we are expecting to see the stock stay around this range, maybe 35 to 45% up today as a result of this excitement towards the name.
Does that mean we could see more deals of this scale in South Korea?
Heidi, I think it's fair for us to say that there is an expectation that the pipeline of deals in South Korea this year will be larger than what we saw throughout 2023. What we hear in the market is that there's a lot of excitement with the corporate reforms that are happening in the country. There is expectation that there will be a lot of value that will be unlocked in some of those large conglomerates that we do have in South Korea, and that we've seen a lot of activity in the secondary market already, a lot of placements, a lot of blocks, some huge names that came to market to sell stakes in Korean companies that are already listed. And of course, this builds momentum for initial public offerings also to happen. There is a lot of excitement in the market. South Korea is definitely one of the busiest places when it comes to ECM activity throughout Asia Pacific this year. And when we talk to bankers, they do see a pipeline coming to market before the end of the year. Yeah.
Of course, the question is, if you've got that level of excitement and interest in South Korea, are we going to see that translate at all?
Well, I think hopefully, well, I think that there is expectation that we are going to see deals coming to market in more than they did last year. Those that are coming to market are expected to trade well. It's important.
Outside of Korea, though?
Well, outside of Korea, I think that's a much harder question. If we look at India, for example, yes, there is a pipeline. Deals are coming to market constantly. They're getting bigger and bigger. Taiwan, you have a lot of activity in the secondary market, a lot of GDS, for example, in Europe. China and Hong Kong, a bit harder to say.
Yeah, where's question marks around the IPO pipeline here? That was our equity capital markets reporter, Felipe Pacheco there. And that's it from Daybreak Asia. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show is next, and this is Bloomberg.